So we're back in Part C on page 9, earnings per share. And just remember, this is basic earnings per share, and it goes at the end of the income statement. Earnings per share, most widely used pieces of financial information. This little ratio, which you did learn last year, or an intro, whenever it was, companies predict or give a prediction of what it will be. These are public companies I'm talking about. As a result, investors will make decisions on buying or selling based on what the next quarter's expected earnings per share will be. So let's say it was going to be $3.26 per share. When that quarter comes and it doesn't reach $3.26, then that will cause the stock price to drop. If it's higher, it may cause the price to increase. And again, it depends on many factors, especially quality of earnings. So, if you take accounting theory as an option, it does go into how accounting can influence the stock market, and shows studies that have measured the change in share price once earnings per share information is released and things like that. So it's very interesting. I find earnings per share very interesting. So hopefully you will too. Now, if you remember, EPS is calculated only on common shares, and that's because they're so significant, it's disclosed on the face of the income statement and or in the notes, but more than likely it goes at the end of the statement. ASPE doesn't include guidance on EPS because it's lesser relevance to private entities. So if you remember from last year, your formula for EPS, net income minus preferred dividends, is that right? Divided by weighted average of common shares, or WACs. So, as you know, preferred shares can be cumulative or non-cumulative for their dividends. If it's cumulative, only take off the current year's entitlement. I don't care if they've been in arrears for 50 years. You only take the current years, because earnings per share is just focusing on the year. If those preferred dividends, if those preferred shares, are non-cumulative, only subtract declared dividends. And then I tell you that all there. If the question doesn't state which type of dividends, only take off the declared for the year. Okay, now calculation for weighted average number of shares. You did learn it in the past, but I can understand if you've forgotten it. The big thing is we're trying to see, with earnings per share, it really tells us what each common share has earned this year. So, let's say half of you bought your shares for my company February. The other half of you bought your share from me, so like I sold the shares, you didn't buy it from each other, in October. Whose money have I had longer to earn my net income? Well, the first group that bought them in February. So they should get a higher weighting because their dollars for common shares have earned more this year. That's why we do weighted average common shares instead of just number of common shares. So let's go through the little calculation. January 1st, the start of the corporation's year. Remember, if it doesn't tell you that, you assume it's the beginning of the year. There were 260,000 common shares outstanding. April 1st, 50,000 new shares sold. October 1st, 20,000 shares were repurchased. So the company goes out and buys them back. Many reasons. Accounting theory talks about that. So if you're interested in that kind of stuff, that's a good option. Compute the weighted average number of common shares. So I suggest looking at how you learned how to do it last year and going with that. There's lots of you can calculate it. I put the important dates first. So January 1st, which is the beginning, and then every other date that something happened, including year end. So January 1st we started. April 1st we sold more. October 1st we repurchased. And December 31st, year end. So we need to know how many months are between all these little periods of time. So January 1st, April 1st is 3 months. This is 6 months. And this is 3 months. So on January 1st, we had 260,000 shares. On April 1st, we sold more. So we sold 50,000, so we add the 50,000 to get 310,000. Then we repurchased 20 to get 290,000. And that's where we're at. So, how long were just these 260,000 shares outstanding? Well, from January just till April, because then they became 310. So this is going to be times 3/12. Then we had 310 shares April 1st. Well, how long did that situation last? Oh, 6 months till there was another change. So that's going to be times 6/12. And then how many does our new total from October 1st last? Well, it lasts till year end, so that's 3/12. So we get 65,000, we get 155,000, we get 72,500. We add them all up to get 292,500, and that's weighted average common shares for the year. Notice these months have to all add up to 12/12, or 1. So, if you've forgotten how to do this and need more explanation, go back to your intro text. The other thing you have to do is if there's stock splits and stock dividends, and there's not going to be a lot here, because again, we're going to do this with shareholders' equity in one of the early chapters in 360. Stock splits and stock dividends. Let's say on November 1st there was a stock split, 2-to-1. You just start at the beginning and go times 2, times 2, times 2, all the way down. But don't worry too much about that. We'll keep this quite straightforward. Okay, so now let's see how it goes into the statement and how to actually calculate earnings per share. So on page 10, we have a little earnings per share example. December 31st, 2024, it had the following shares outstanding. 10% cumulative preferred shares. How many years did we show? Do 1 year only. This many shares outstanding, and that's the dollar value. Now, do you remember what you do? Sometimes they give it as a dollar value. So if it was $5 times the number of shares. If they give you 10%, you take the percent multiplied by the balance. So this is the balance. Notice this is in dollars. This is in shares. So use the dollar balance. Common shares, 3.0 shares outstanding. During 2020, the corporation's only share transaction was the issuance of 330,000 common shares on April 1st. Then they had income from operations before tax, discontinued operations before tax, a loss, preferred dividends declared. Notice they just did 1 year, 10% times the balance. Common dividends declared and the effective tax rate. Calculate earnings per share as it should appear in the financial statements. Let's do the earnings per share calculation first. So, earnings per share, we're going to set it up. So this is the format, fill in the numbers. So over here, we're going to have earnings per share on income from continuing ops, discontinued ops loss, or you can just put discontinuing ops. You don't need to put the loss in. And then we're going to have net EPS. So that's going to be our little format. And that goes at the bottom of income. We'll do our earnings per share calculations here, but we have some calculations to do in the middle because we need net income. Is net income before tax or after tax? I'll just write the formula up here since it's from a different page. EPS is net income minus preferred share dividends over WACC. So we've got net income. We don't really have it. We don't have it after tax. And we don't have WACCs. So let's do WACCs first. January 1st, there were how many shares outstanding? This is at the end. So there were 3.8 million. So we know after they sold the extra 330,000 on April 1st, there were 3.8 million. So how many did we have on January 1st? Well, 3.8 million minus what they sold, 330. So that works out to 3,470,000. Now, January to April, 20 months. January, February, March, don't count April because it's April 1st, so that's 3 months. So what does this have to be? 9 months. And you total that up, and you get 3,717,500. Okay, so we've got one piece done. We've got our preferred share dividends done too, but what's missing is because we have to separate discontinued income from continuing, we don't kind of start with net income. It has to be in two pieces. Discontinued and continuing ops. Okay, so I'll show you how that works. Let's start with first calculating the after-tax amounts here. we need a tax amounts for the calculation. So for continuing ops, we start with 24,490,000. Now the tax rate is 32. I want after tax. Do I multiply it by 32%, or can I do something else to take a shortcut? How do we get after tax? Times it by 1 minus the tax rate. And that gives after tax amounts. So whenever you're looking for tax, you just multiply it by 32%. If you're looking for the after tax, what's left over, then you want the inverse, I guess, of that. So that's going to work out to 16,653,200. Then we need discontinued ops. And that's going to be doing the same thing. Look at the discontinued ops. It's a loss. And that is 3,152,000. Same thing, times 1 minus 0.32, which is 0.68. And that gives us, sorry, I'm squishing it in, 2,143,360. So now we have our pieces that we can calculate with. So let's do this one first. So instead of net income, we take continuing ops. We calculated continuing ops as 16.6532 million. So our EPS is going to be 16,653,200 minus the preferred dividends. Now, let's say they declared 2 years or 3 years to catch their arrears up, you would only put the 1 year. Or let's say they were cumulative, like they are, and it says we haven't declared any in 5 years, so we're 5 years in arrears. You would just put the current year. So either way, you would put the 1.126. And divide that by weighted average common shares. So that works out to 4.18. So that goes up here.